Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on the Economic Show, we're going to break it up into three parts. One is going to be an overview in terms of the US, Europe. The second is going to be a deeper look at some key economic drivers, specifically PMI. And then the third is going to be a deeper view of consumer trends as viewed through the lens of Vegas. So just kind of diving right into where we see the shape of the economic recovery. So this is an interesting view. It's according to CEOs in terms of kind of where they see the world shaking out. And the most common view is either the stagnation or the slow recovery in Q3. So we believe it's going to be something of a mixture of the two. We don't believe in a V. We don't see is there a potential W with another steep contraction. We are more along the lines of a stagnation with some bright spots within this slow recovery of Q3. So we think that there's areas in which Q3 is going to be interesting on a global level. But again, stagnation is going to continue to be a huge overhang within the market. And the reason why we believe that is, back in 2019, we were talking about coming in relatively bearish. We saw distillate demand starting to fall. We saw issues starting to arise as we came through the end of the year. So for us, COVID, while a massive move, was more of like a jet fuel on a forest fire type situation. And we were already coming into this struggling period of economic growth, which comes back to the stagnation component as you had consistent support from central banks, even as you had economic activity slowing. And this is an interesting breakdown because we keep talking about the loss of employment and what does that mean as we continue to see furloughs and announcements of some very high paying jobs, or at least what would put you in the middle to upper economic or income levels. You're starting to see there's a loss of income that has only accelerated, especially as we have programs like the PPP, other SBA loans starting to run out, and you're starting to see some of these furloughs really kind of come. And this is going to be the bigger problem on consumer spending, which we'll talk about, when some of the new data comes out. But the bigger one here is the U.S. exports imports. The annual growth. Again, we were coming into the slowdown. We keep talking about on the EIA show, on our OPEC show, the problems that we're seeing in the shipping market. So it shouldn't be a surprise to see exports and imports continue to struggle. Now, while they're down, they did come off the lows, which should be considered as a positive, especially as the U.S. dollar continues to weaken. The bigger problem is going to be as the euro continues to strengthen. And when we look at the way European, how their economy is doing, we have to weigh the fact that Germany is a big driver of Europe and they're a huge exporting nation. But as the euro continues to rally, is that going to be an overhang as we go forward in terms of just new economic activity? And that's why when we talk about, what has happened in the U.S., the U.S. debt is projected to rise to about, let's just say 98.5% of GDP in 2020, which it's probably going to take that out. Euro area debt to reach over 103%, according to the ECB. And this is a bigger issue in terms of just the Treasury bills outstanding, and which have to get rolled, continue to have to be moved over in order to really kind of close this gap, which is the fiscal stimulus that we continue to hear about from the government. The Dems have come out with a $3.5 billion spending plan. The GOP is talking about something closer to $1 trillion, and it'll be somewhere in the middle. But the question is, how is that money going to be delivered to the general public? And when you think about, what's the buffer? When you consider what the GDP gap is going to be, and when we think about the GDP gap, you have to break it into its pieces. And when we look at this, the federal budget deficit, it continues to grow because not only are we spending, but we're also losing a significant amount of tax revenue. That tax revenue is being lost because the inherent GDP the growth just isn't there. We're continuing to see consumers not spend at the same levels, companies not not invest. We're coming back to the export-import side, continuing to fall. These are key aspects. The government has stepped in, and you've seen government spending increase in terms of construction, but residential, non-residential has fallen, which will continue to be an overhang. But the Treasury is sitting on a huge cash cushion because we know that there's going to be a significant outspend as we go forward, which is why we're starting to see this historic gap, which is only going to get, in my opinion, only going to get worse, especially as we have fiscal and monetary stimulus, which remains to be pushed into the market. And that's when we turn to 2Q growth within the euro area. The end of on Friday, we had additional reporting. Spain continues to be the one to struggle the most. France even though they came in at about 14%, they're actually seeing some of the biggest turnaround, where Spain is continuing to see an overhang, especially given the other issues that are happening on a political level, but also what's going on within the country itself on the spread of COVID. And that's when we turn to Q1, Q2, and kind of what does that mean in terms of the virus damage as we go into the remainder of the year. Now, France has seen the biggest increase in daily activity, where Spain, Italy is starting to falter. The problem is going to be Germany, because Germany, even though their numbers are starting to get better, they had another tick higher in COVID cases, but exports. What is the increased value of the euro going to do as inflation increases across the globe? China, Asia, the Middle East, you continue to see an increase in inflation in some of these areas as their currencies fluctuate against a rising euro, which is going to be problematic when we consider how are they going to incentivize additional purchases and increase exports? So does that mean that the ECB is going to have to do more to try to weaken the euro? How does that interact with the US dollar, which has continued to see weakness, which has obviously sent gold and silver parabolic and has kind of dragged WTI along with it? These are things that are going to continue to weigh on the economy as a whole. And then this is when I start to hear about, well, what about the dollar as the reserve currency? Well, the question is, what are you going to replace it with? And right now, we don't really have a clear defined answer, which is going to keep the US dollar in its current place at the moment. But when we look at the Eurozone and we turn to the UK, you can see that the loan loss charges are increasing as well. So we showed a chart a couple weeks ago, right after the banks reported, and you saw the huge increase in bad debt expense, and obviously there's the same thing is happening here. And the question is, really the problem is because you're seeing an increase in unemployment, seeing a decrease in hiring, and now there's a huge amount of debt, where the debt inherently is the biggest on a global level in history. So now there's just more debt that has to be accounted for because people are not going to be able to pay it back, or at least not pay it back on time, which is increasing this bad debt expense, which is going to be a huge overhang on banks and their ability to lend, which we talked about last week and we'll highlight again this week. So coming back to Europe, you're seeing those increases in terms of just daily activity. Now, you're seeing stalling out in some of the specific areas, specifically Spain and Italy. Spain being the biggest problem in terms of starting to see that decline. Germany has stabilized, and the problem is you're going to get that overhang with the exports. You're starting to see a slight increase in terms of COVID cases, but France has done fairly well. France is something that we think is going to continue to see a certain amount of normalization. Does it get back to 100%? I'm going to say no, but there's no reason why they can't get back to 92% of the previous pre-COVID highs. Germany's one where I think you're going to start to see that slow down and come back towards that 80% activity. And when we think about, okay, well, what about the biggest cities? Now, average road congestion levels in Berlin, London, Paris, Rome, and Madrid were down 38% versus a year earlier. Now, you're starting to see some pullback. Now, this is an increase where economic mobility in Europe's top 5 economies are largely flatlined in July, but with an average mobility decline of about 21% on a year-over-year level, looking at pre-crisis. Now, this is something where we've seen it get a little bit better as we've come into the end of July, but now you're getting the overhang of Germany. So these numbers are really not going to increase all that much. And given the pressure that we're seeing in Spain, forming again in Latin America, you're going to keep seeing this pressure specifically on mobility, which is going to lead to less diesel demand, less gasoline demand, and inherently less oil demand. And that's where we come to our current activity indicator, which, Goldman puts this together and you can kind of see what is driving this. Again, it's just a way to pick apart the data. There's some bright spots where we did have an increase in manufacturing. We had an increase in demand of new orders. We saw consumer goods go up again, which is again a positive. But the labor continues to be a huge overhang where we keep seeing contractions. ADP put in a negative number, a net number that was a positive, but a huge miss versus estimates. And this is something that's going to continue to be an overhang for just the general economy as a whole, not just in the US though, because we're seeing unemployment problems, job problems on a global level, which is just going to be an overhang for just general activity as we go forward. And just looking at the US as an aggregate, and this is the data that came out today, we had services data, service index, surprise to the upside, which is a positive, and we'll go through that in a bit more depth. But we want to leave off this segment with really looking at the ADP employment change. So we were expecting about 1.2 million increase in jobs, and we had 167,000. Now, this is a big slowdown because there was an expectation for an increase in retail, an increase in hospitality, and we see that it just didn't come through. Now, we get the official numbers from the government on Friday. That's something that we're going to talk about during our Frac Spread show. But here you can see that the early indications are for a significant problem. And if you think about the amount of job loss on April 20th of 19.4 million, we've only added back, let's call it, almost 8 million jobs, but we continue to see continuing claims sticky above 17 million. And we keep getting surprises to the upside on new initial unemployment claims, which will be that overhang that we continue to talk about as we look at employment and inherent consumer spending on a go-forward basis. Now we're going to turn towards PMI, or the Product Managers Index. The bigger problem that we're starting to see and others are starting to write about is the quality of the information that they're getting, given companies are struggling, their inability to respond to the surveys. And it's not to discount some of the numbers because they are getting better, but we have to look at the broader picture to make sure that we're capturing some issues that may not be clearly picked up in the PMI index and as we look forward, especially when we consider unemployment or what employment looks like going into the next few months as COVID remains a bigger problem and a forefront of people's minds. But when we look at the breakdown of PMI, you can see that June into July, we had a nice increase, and it just continues to show an expansionary period. New orders remain the benefit in terms of where we are, and inventories remain low. So we should continue to see inventories get restocked, which is going to keep new orders and production relatively elevated. The bigger problem is employment, where you're seeing companies start to rationalize, well, can I fill some of these new orders keeping and running lean because I don't have the capital to try to manage and bringing back new people? And this is going to be the bigger problem when we look at how sustainable is some of this rally if we're not getting employment back. And you could say, well, it's a lagging indicator, people are going to be hiring. But as we go into an uncertain period of cold flu season, coming out of this restocking period, I think that's why you're seeing this lag where companies want to understand, is it restocking or is it real? Are we getting this big pickup? And that's where we see the new export orders, they're starting to flatten out. And then the backlog is also getting there, but it's starting to flatten out. And the question is, are we going to see this meaningful increase? Now, you can't have manufacturing go without services, and services did have a nice tick higher as well. The question is going to remain, when does this translate into more jobs, more hiring, especially as we have an end to fiscal stimulus right now? there's still negotiations going on in terms of what the new stimulus looks like. But this is the advent of, we had a lot of capital come into the market. What does it look like if some of that capital is removed, especially as we have weights on trade? Trucking, as we talked about in the EIA show, trucking remains a bright spot, but rail shipping remains slow. So there's this give and take in terms of what is actually real and when does this start to fall in line and we start to see additional increases in employment. And the Asian PMIs are seeing something similar in terms of this recovery that we keep talking about. Now, China, we went through in depth in last week's write-up, which you can reach out and we'll be happy to send. And it's just, we're looking at China in terms of trying to massage out what is the real number. And we can see that China's PMIs were really driven by construction, specifically government-sponsored construction. And we're seeing a continued pressure on the consumer side. And the problem is the consumer remains the overhang in a lot of these countries, which is not something that's going to readily go away, specifically as we keep coming back to employment. But an interesting data point in terms of the flow back to countries as members of families leave countries to get jobs in other areas and then send back that capital. If you have individuals in the U.S. that are working hourly wages or working in salaried jobs, a certain percentage of that is going back to their hometown. And this is something that has happened across a lot of developed nations. And as well as within the Middle East, they rely on a lot of immigrants to really kind of carry the workload, and some of this money goes back. And you're seeing that as we get pressure again on the employment side, that is also going to reverberate back to a lot of these emerging markets, which we continue to talk about, where emerging markets are going to struggle more than I think the market really appreciates. Looking at this is an interesting way to consider. It's like, well, we know that they're struggling locally, that's data that we can readily get, but what about the money flows that we normally see coming from one country into another? And this is something that's going to be another overhang in terms of potential spending. And coming back to the daily activity, we're starting to see again that normalization and that move lower, with Japan issuing a new state of emergency in specific areas. And again, these are the weights that are going to keep us on average between that 75, 80%. And it's just going to be difficult to see that gap close without a further stimulus, which is, is it a good thing, bad thing, given where inflation is going, where the market sits? That is a whole other discussion. But really, as we head into what is going to happen with schools? Are kids going to go to school? And then what does that look like in terms of cold and flu season? And if we get a resurgence of COVID? And that's why when we talk about PMI and we start to look at, okay, well, we talk about unemployment, we talk about money going back. Well, what about factory jobs? And this is where again, we talked about the US. Well, maybe it's different elsewhere. And this is a way of looking at, well, it's not. Factory employment just hasn't gotten back to any real normalcy. And Germany is an interesting one in terms of how much it's fallen. And the problem is, given with the way the euro has rallied, are we really going to see German manufacturing turn back around to a level where we see employment pick up? Japan has missed their car manufacturing is down in May. It was down 61% year over year. We continue to see slowdowns in the export market, and specifically South Korea, Japan, Taiwan, China, Germany are huge bellwethers for the export market, and they continue to remain well below in a contractionary level for employment. France is one that has, as you can see, has come greatly off the low, and that's the one that could be the bright spot especially in relation to the rest of these countries. And when we turn back to the U.S. and we consider that personal income, we talked about the tightness or the inability to get new loans, and lending lending was starting to get tighter, and the personal income is becoming a focal point, because you see the increase that we have from total personal income. But it wasn't driven by wages and salary. It was driven by some of these fiscal handouts in terms of transfers from rebate checks, unemployment benefits, and more importantly was the in that rebate check was that stimulus check of $1,200. Now, as that has normalized, you can see personal income got a nice spike, and it was a spike above where we were in 2019, which should be considered when you think about, well, spending has increased, so obviously everything is better. It's like, well, you had a lot of extra money fall into people's pockets. And now the question is, where is that? Is it going to be the same? Is it going to be less? And that's where we start to look at where personal income is starting to normalize. And we think personal income is going to continue to fall, which will weigh, coming full circle, on consumer spending as we go through the remainder of the year. And this was a chart from last week, just looking at how standards are starting to increase for lending. And as we look at standards, we're starting to see an expectation of more rejections in terms of new loans or new mortgages. And that's why we look at the willingness to lend to consumers. And this is another way of looking at that chart, where the respondent reporting on willingness to make a new loan or install loans is fallen back towards, it hasn't quite reached the depths of the financial crisis, but we're getting to those levels. And if you remember back to the bad debt expense, which we've seen not now in the UK, Europe, and the US, as the bad debt expense increases, banks have to be more cognizant and protect their balance sheet more, which is going to keep this lending pressure in place, even though you would think, well, rates are falling, so things are getting better. It's like, no, there's still a problem when we think about, as coming way back to the top of this segment and to the first segment, there is an issue not of just employment, but also that the income levels. So as income falls, can you really support the loan that you're requesting? And that's why we look at rates, because rates continue to fall on the fixed 30-year fixed rate mortgage index on a conforming level. And this is looking at it based on credit levels. And as you can see, they've all come down. And even if you have the worst credit that is mapped out here, you can still get a mortgage for 3.5%. But you're starting to see an unwillingness or hesitation creep into the market as bad debt expense increases and the concern around income becomes a bigger issue. So now that we've talked about lending tightness, and some of these issues on personal income, now we can start to look to the consumer, and the focal point will be Vegas as just kind of a highlight of how is the consumer doing, with the view that Vegas is where you'd spend a lot of your a piece of your discretionary income. Now we get to turn to Vegas and really kind of dig into where are people really spending discretionary income? I mean, where do you go to burn money more than Sin City? To go to Vegas, gamble, go to shows, eat lavish meals, just spend general cash and have a good time. So given that, some of us may not make the most money, but in PVN, we have one of our degenerate gamblers who is now in Vegas right now. And he's given some good insight into what is actually happening. What is on the ground? Let's ask him questions. In the future, we'll give him a microphone and have him run up to people and do some crazy things on the sidewalk. But just looking at where's hotels? Let's look at occupancy, because when we start to talk about hotels, we have to consider, what are they doing? How are they operating? And how are they trying to just cover some of their costs? So the Wynn and the Encore, which are 2,500 room properties, have a max amount of about 600 rooms that they're going to rent out. And the way that they're doing this is, out of the 600, even if they get to their rates, they're not going above it. So out of the 600, we've seen about 25% utilization rates during the week and up to about 50% on the weekends. Now, even though this sounds like, okay, well, they're cutting capacity so they can actually protect rates, but we're actually seeing that hotel prices still remain relatively low, even for 4 to 5 star hotels. So these are the interesting things when you're considering about, well, how are people getting away? Even if you're in driving distance, getting out of some of the areas, because obviously, flying is difficult. But even with these the ability to drive. You're not seeing people really show up in the same way, but it's starting to creep back, specifically on weekends. Some of the little tidbits that we've seen, Caesar sold Rio to real estate group who closed the property and are refurbishing the interior through the summer. So when we consider construction, the one thing that was noticed was that the redesigns, the construction continues to push forward. And if you consider getting cement, materials, people to these locations, it's a little bit easier, obviously, with less traffic. And a lot of these, like Mandalay Bay, continues to do interior redesign. These are opportunities that you can take where, let's just do the redesign now. If it takes an extra month, so be it. We can get everything. And then once COVID, we're on the other side of it, you have a brand new facility or a facility that has gotten a facelift. Planet Hollywood remains closed, but Bally's reopened last Friday. And for the most part, the majority of the hotels aren't running valet just to avoid touching personal space. But downtown, some of that is a little different. And they're trying to use, wipes and trying to have people feel comfortable about these different sanitation methods. An interesting component is Resorts World Las Vegas designed their hotel in both the shape and exterior color of Wynn. Now, Wynn sued, they won the lawsuit, they said that they were going to change things. Instead, they just kind of doctored it up and it still looks exactly the same, which is an interesting little tidbit when you're just to prove that we do have a person there on the ground. Now, going back to sanitation and considering, what are they doing to make sure that people are safe or feel safe? And our man on the ground had gone through the Bellagio, Cosmopolitan, Wynn Resorts, and they were seeing a big focus on making sure people are wearing their masks, making sure that they're staying safe with the way that they're doing things. But then others are a bit lax in terms of how are they cleaning things, how are they adjusting and holding to mask policy. And some of the interesting things when you're considering, at a casino, what are you doing more than touching the chips, touching the cards? And chips were cleaned multiple times per day with cards constantly replaced. Mask wearing was mandatory with spotters everywhere. So spotters are people that were running out and saying like, hey, you need to move your mask back above your nose. Just someone who was having a cocktail, it's something where as soon as you put your cocktail down, you have to put your mask back on. And if you don't do it immediately, somebody is coming up to you to tell you to put your mask back on. Again, this is changing based on where you are, but the Wynn, for an example, was very good at maintaining some of these mask rules just to make sure others are safe and just to keep the spread from happening, because the worst thing that could happen is another shutdown. And, the other interesting thing is like, well, what about food? What about drinks? What is happening? So bars remain closed, but if you go to the bar, you have to order food as well. And if you're ordering food in a restaurant, you're only allowed to take your mask off once you actually place an order. So some of the buffets remain closed for the most part, except in the Wynn, where it's now seated. So you can sit there for a 2-hour time allotment and you can order as much as you want off the menu, but you're not allowed to go up, minimize the touching and keeping those things, separated. The bigger side of, as we start to go and think about, okay, well, what is happening on the ground? Uber and Lyft remain open because they're vital, not only just for moving people around the city, especially from the airports between different casinos and hotels, but also as a means of secondary income, because you still have more furloughs. We have MGM, which has let go a majority of their entertainment staff. And when we say entertainment staff, we're not talking about the people building the sets, but the people that are getting the shows, putting them together, some high salary figure jobs that are just gone. And it's not something where they're gone permanently, but are they gone for 12 months? Is it 18 months? When do things start to normalize and they feel better about getting people to fill these shows and to really start to get things back to normal? So the other interesting little component when you're thinking about these tens of thousands of people that are going to start missing rent payments and other types of issues is the entertainment jobs. And we talked about the entertainment jobs in terms of creating the shows, but what about the people themselves? And here we have Celine Dion, Gwen Stefani, Shania Twain, Christina Aguilera, which are either renegotiating contracts or essentially not performing at all until at least 2021. Now, these are drivers of people coming to Las Vegas. What are you going to do in Las Vegas? The strip clubs are closed without being reopened. You now have entertainment, which is nil to just because people don't want to sit that close. How do you space it? How do you clean everything? And this is where, what is Vegas going to continue to do to incentivize people to come and you really spend money? And the idea is creating a safe environment for food and gambling and ways to kind of integrate that. And then when we turn to, okay, well, what is personal spending on live events across the US? Because you could say, okay, well, is Vegas separate? Is Vegas different? And when we look at personal spending on live events, it's pretty much zero, as we've saw the drop off that started in March and remains pretty much nothing. So when you're considering MGM, just Las Vegas in general, trying to save capital, what's the best way than to kind of shake some of these expensive contracts, high-paying salaries, and furlough them because people aren't going to spend money on it anyway. People don't feel comfortable there. They're comfortable enough to get there, but are they willing to sit in a show? And just looking at the normalcy, we're taking away and looking at this chart, you can see that the answer is no. And that's not something that's going to come back anytime soon, especially as we go into that, as we keep talking about that cold and flu season. So these are key components that we have to consider when we're looking at the economy as a whole. So these are some fun little factoids about Las Vegas. We covered a lot today in the economy show. Thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.